Hello and welcome to this video by ACCA on financial management exam, and we're going to look at in this video on overcoming challenges within the FM exam. The agenda here is that I'm going to talk about myself first, and then I will talk about the three challenging areas, and then we'll move in specifically to those three challenging areas. One on investment appraisal, the other on business finance, and then finally on working capital. So without wasting any time, let's go into the first agenda topic, which is myself. So here are my details. I am Waleed and I teach finance and management papers at PwC's Academy in Dubai. I have put my contact details there, so in case you wish to contact me on anything in relation to this video, or you would like to speak to me on anything about FM, please get in touch on my email address, which is waleedminhas@hotmail.com. Let's look at the three challenging areas then. Well, the three challenging areas in FM exam are built on the core areas, and I feel that investment appraisal, business finance, and working capital are challenging because they are the core areas of the FM exam, and these are the topics which can be tested in section C of the exam. So let's look at these one by one. So first of all, let's go and have a look at the investment appraisal side of things. Now, traditionally on the investment appraisal side of things, we get to do questions on net present values, IRR, payback, discounted payback, etc., etc. But the thing here is that we are going to look at lease versus buy. Now, that's a topic which has come up a few times over the last few years, and it has caused difficulty to the candidates because they think it's something very difficult, but it's really easy. And I just want to get that fear out of you that if this topic comes back again, which is not traditional, we all are fine with NPVs. We can do NPVs, we can do IRRs, we can do paybacks, but then what about that topic which the examiner has tested a few times over the last few years? And we must be ready to do lease versus buy as well. And we'll also look at a few Npv and Irr tricks that can be played in the exam, and then you can save a lot of time playing those tricks. Let's look at the lease versus buy first. In terms of lease versus buy, the aim is to find the cheaper option. And when I say I want to find the cheaper option, I mean that is it the lease option which is cheaper, or is it the buy option which is cheaper? To do this, we need to know about the cash flows that get involved here. Now, the lease cash flows are the lease rentals and the tax saved on lease rentals. Then we have buy cash flows, which are investment, scrap value, tax saved on depreciation, and running costs. Now, this is quite a big list of cash flows that you may see, but to be honest with you, the examining team doesn't really go that far. Yeah. So although I've mentioned everything here, but perhaps there is no tax. And I'm talking about the Millennials question in 2018, which just said ignore the tax. And if the question says ignore the tax, then that means the lease rentals will be there, investment will be there, scrap value will be there, but there will be no tax. And perhaps running costs will be there as well. Okay. But if the tax elements are there, then if the examiner says that the lease rentals are tax allowable, well, that is one of your cash flows for the lease scenarios. If the examiner says that depreciation is there and you must work out the tax saving and depreciation, then you must do it. Okay. What we'll do with all these cash flows is that we'll discount them at a post-tax discount rate. So there's a pre-tax discount rate and there's a post-tax discount rate. We must make sure that we use the post-tax discount rate if the tax implication is there in the scenario. Why is that? because obviously the cash flows have got the tax element. The cash flows have got tax element through the tax saving on the rentals and through the tax saving on depreciation. And if that's the case, then the appropriate discount rate is a post-tax rate. The post-tax discount rate will be lower. The pre-tax discount rate will be higher. And if the examining team gives you that complication, choose the post-tax discount rate if the cash flows have had some tax adjustment done on them. We'll take the lease cash flows, we'll take the buy cash flows, we'll use the discount rate, and then we will simply find the cheaper option by working out the total present values here. And that's it. It's very, very easy. So what we can do now is we can have a look at a little example. So let's have a look at a little example here. And what I would like to do is I would like to have a look at this example, which is on the lease versus buy scenario here. And we can just look at quickly how you've done things there. So in the lease scenario, the rentals are $55,000, and let's say they are in advance. If it's a 3-year useful life of the project or the asset, then the rentals are paid at 0, 1, and 2. The discount rate 8%, investment of 160, scrap value of 40, and the running costs are $8,000 per annum. Okay, it should have mentioned per annum. All right. Now, if we look at the lease scenario, the first thing is that we should be doing 0, 1, 2, 3, and looking at the timing of these rentals. The timing of these rentals is 0, 1, and 2. Why? Because it's a 3-year asset and the rentals are paid in advance. There's no tax implication here, so we will just simply discount these rentals at 8%. And once we discount them at 8%, we get the present values of these rentals. The total present values are 153,065. And what I've done just simply is I've taken the lease cash flows, which were the rentals, and then discount them at 8%. If you have to look at the buy scenario, remember the cash flows, investment, scrap value, running costs. So the first thing we'll do is we'll just input all these here. The investment of 160, scrap value of 40. The reason I've shown this as a negative is because obviously it's an inflow and we're talking about the costs on the other side. And the running costs from year 1, 2, and 3. We find the total cash flows, we discount them at 8%, and we find the present values. And you can see here that the total present value in the buy scenario is lesser as compared to the lease scenario, which was 153. And because this is a cheaper scenario, we'll opt for the buy scenario because obviously we'll save some money here. That may not always be the case. You need to look at each scenario separately. I've given you all the cash flows. The only two things that I didn't put here in the scenario were the tax implication. Well, if there is tax implication and the examining team says there is some tax saving on depreciation, it should come here. It should come within your buy scenario. If there is any tax implication on the rentals, it should come here after the rentals. That what's the tax saving on these rentals? Okay, so if the tax implication was there, we'll input here and then do the same thing, discounting them at a post-tax discount rate, and we'll opt for the cheaper option. And there's nothing else to do here. So this is how lease versus buy questions are done, which are very easy actually. But the problem arises that sometimes we are not sure on the cash flows. And I have given you all the cash flows on the slide, and I've given you the discount rate. And your work is just to go in, find the present values, and then opt for the cheaper scenario. So I hope now we are feeling a lot more confident on our abilities to do the lease versus buy scenarios. Next thing is how you can save time in the exam by employing some tricks around Npv and Irr. Well, what you can do is you can use the Npv function and you can use the Irr function as well. So use Npv function and use IRR function. That's what you can do in the exam. And let me show you how. Well, what I've done here is I have taken a cash flow from this specimen exam question VIP. This is your net cash flow or the free cash flow. Now, I'm not going to discount it using the present value factors from the table. I'm not going to do that. I want to show you how you can use the Npv function. How you can use the Npv function to find the Npv. That is quite easy because this is what you do. You say equal to Npv, and then in the brackets you take the discount rate, which is 10%. Then you specify the range of free cash flows, which are, or net cash flows, from the C3 to the F3. Now these are all the cash flows that you need to discount in this question. The discount rate was given, so once you will rework or do the full question, you will see the discount rate in this question was 10%. So you discount those cash flows which you want to discount, and they are from 1 to 4. You don't want to discount T0 because T0 is already in present value terms. So what do you do with that? You just add that T0's cash flow separately as the B3. So Npv 10% C3 to F3, and then we are going to add the investment separately. Now, once you've done that, we are just going to press enter, and we get our Npv, which is $367,000 or $368,000. That's it. It saves a lot of time. The IRR function, very easy. You have got all the free cash flows or the net cash flows given already. You just need to say IRR and specify the range of all the cash flows from B3 to F3. So B3 to F3, and that's it. So B3 to F3, all the cash flows, all the net cash flows. And there it is. Your IRR is 18%. So you can use these functions in the exam to be really, really quick with things. You don't need to put in the present value factors, but of course, if you really, really wish to use the IRR formula, use it. But if the function can be used somewhere, please feel free to use it on the free cash flows and save time. Please use the Npv function if you can and save time. Okay. So that is it on the challenge 1, which was on the investment appraisal. And I now hope that we are very confident on lease versus buy and saving some time in the exam and using Npv and IRR functions. Next, let's move on into the challenge 2, which is on business finance. Now, in business finance, we are going to look at the WACC. And the reason I want to look at the WACC is because obviously it's a very core area, and sometimes we struggle with the sources of finance. You don't need to worry. What I want you to do is to take percentage of each capital from the total capital structure and multiply with its cost. Percentage of each capital from the total capital structure and multiply with its cost. And then you add all of these, and you get a WACC. Percentage of capital from the capital structure and into its cost. And you add all of these together to find a WACC. The problem is that when you have more than 2 sources of finance, it's a bit of a tricky calculation, because then you need to find the values of all the sources and the costs of all the sources. The formula on the formula sheet says equity and debt, but doesn't really differentiate between the different types of equity and debt. And that's your work. You should know how many sources of finance can exist. And I'm telling you, there are 6 sources of finance that can exist. You could have equity, which is ordinary shares. You could have preferred shares. You could have redeemable debt. You could have irredeemable debt. You could have convertibles, and you could also have bank loan. So ordinary shares, preferred shares, redeemable debt, irredeemable debt, convertibles, and the bank loan. 6 sources of long-term finance can be there. We must know how to find their values and how to find their costs. In terms of finding the values, it's very easy if you know the formulas. I've put in all the formulas here. Let's look at these. Ordinary shares through the VE. Share capital divided by par into the share price. Preferred shares, VP, share capital divided by par into share price. Now, although these both are same, but we must know that the share capital of ordinary shares and share capital of preferred shares are 2 different things. Par value of ordinary shares, par value of preferred shares is 2 different things. Share price of ordinary shares, share price of preferred shares is 2 different things. So these are all different things. So share capital divided by par value into the share price is how we worked out the VE and the VP. To summarize these 2 workings, it's very simply number of shares into the share price. So what are we doing by taking the share capital divided with the par? We are finding the number of shares. So number of shares, ordinary or preferred, into their respective share prices. VD, redeemable debt, first of all, and you can see all the debt have the same symbol, which is VD. So VD of the redeemable debt, you take long-term debt, which is there in the SOFP or within the scenario in the paragraphs, divide that with the par value, which is 100 for the debt, and then into its market price. We're doing the same thing here. We're taking the number or units of debt into the market price. And if you see irredeemable debt, same thing, units of debt into its market price. Convertible, same thing, units of debt into its market price. So it's very simple actually to find the values. It's just the number or the units into their market prices. And we will be given the market prices in this topic of working out the WACC. Bank loans, the easiest, because bank loans are non-traded, which means their market value is the book value. So you don't need to do anything. You just need to take the book value of the long-term debt of the bank loan, and that's it. That's the VD of the bank loan. Okay, so these all are assumed that we are working the market value WACC, and therefore the market values are required. And I've shown you the 6 sources and how to find their values. To summarize, it's simply the units into the market price. That's it. But to find those units, obviously, you need to take the value, the share capital or the long-term debt, dividing that with the par. The bank loans are easiest because the book value is the market value. We must also be ready to work out their costs. First of all, ordinary shares, KE, can be found through arranging the growth model or the CAPM, which I hope at this point of your studies you would have been comfortable doing in your full studies. Obviously, in this small video, I can't really do everything, but I'm just making sure that you know how to do things. The preferred shares, cost of preferred shares, fixed dividend over the market price. The redeemable debt and the convertibles are solved using the IRR structure. Remember that IRR structure, which has got the market price, it has got the interest, it has got the redemption value or maybe the conversion value, and we discount those at 2% and use the IRR formula. That's the IRR structure. Irredeemable debt, interest 1 minus the T over the market price, and then bank loans coupon percentage into 1 minus tax, assuming that the bank loan is on fixed rate. So that's how we can work out all the 6 costs as well, which should be quite easy if you know the formulas and if you've done the questions on each one of them. Now, once you know all these, then you put everything into the WACC formula, which may look like this if it has 4 sources of finance. Now, assuming the sources are ordinary shares, preferred shares, redeemable debt, and the bank loan, these are the WACC computations here. So you need 4 boxes. You need VE, ordinary shares, divided by entire capital into its cost. VP divided by entire capital into its cost. VD, redeemable debt, divided by entire capital into its cost. And then VD of the bank loan divided by entire capital into its cost, and then you add everything together to find the WACC. The problem is the formula sheet shows a formula which just has broadly equity and debt. It doesn't show the breakdown of the different types of equity and debt, and I'm telling you, if there are 4 sources of finance, which are ordinary, preferred, redeemable debt, bank loan, then this is how the WACC formula should look like. Let's have a quick look at a question here, which will help us with this. And here is my WACC question. I have worked out all the values, I worked out all the costs, and you can see I've totaled up all the values as well. Now what I need you to do is to multiply values into the cost. So let's start with the ordinary. Take the B5 divided by B9 into its cost, which is C5. Done. Then take the value of preferred shares, which is in B6 divided by B9 into its cost, which is C6. Then VD, we take the B7 divided by B9 into its cost, which is C7. And finally, we take the bank loan, which is B8 divided by B9 into its cost, which is C8. And once we add this column, we say sum from D5 to D8, and that will give us the WACC of 10%. So this structure really simplifies that entire WACC working for you, and you really don't need to worry about things here. But assuming that we have done questions where we know how to find all these values, and we know how to find all these costs, and then using this structure to finally calculate the WACC. So hoping we are now more confident if there are multiple sources of finance used, how can we do the WACC? There are 6 sources which can be tested as we agreed, but the examining team usually tests 2 to 4. If there are 2, it's very easy. If there are 3, it's okay. 4 means that we should be able to compute all these 4 different values and 4 different costs. But I hope that by using the different ways how I've shown you the formulas, I hope that now you're confident in finding these, and those formulas are really, really important. The next thing is we need to look at the challenge 3, which is working capital. Now, in working capital, I have taken the topic of receivables management and especially the topic of offering discounts because it seems to be a key skill on the working capital questions. Receivables management, especially the offering of discounts. A business must ensure that the cost of offering the discounts is less than the benefit of offering the discount. The benefit of offering the discount should be more than the cost. Well, what is that benefit? The benefit is the saving in the cost of financing. And what's the cost? The cost is the cost of discount itself. Now, cost of financing can be found by receivables into the overdraft rate. It's an interesting calculation, and I want you to think the rationale behind this. Receivables into the overdraft rate is basically saying that if we have receivables in current assets, these people owe us the money. We don't have this money, they have the money. Now what we will do is, to meet our operational needs in the business, we are going to borrow equivalent of the receivables from the bank in terms of overdraft and pay overdraft interest on that. So to find the cost of financing, we take the receivables which are on our current assets and we multiply with the overdraft rate because that money is with them. And if we want to meet our operational needs, we need to borrow from the bank and then pay overdraft interest on that. We must ensure that if we are offering discounts to customers, then obviously the cost of financing is going to come down. Receivables will come down, cost of financing will come down. So there will be some saving. That saving in the cost of financing is more than the cost of discount itself. The saving in the cost of financing is more than the cost of discount itself. Now let's look at a small example on this. and make sure that we are happy with it. So I have put this example here. Example is on receivables and the discounts. So we have got here the receivables as $10,000. The overdraft rate is 5%. Cost of discount is 0.2% on sales of 50,000, and the revised receivables are 7,000. Well, obviously you can see the receivables balance is going down because of the discount. What you need to do here is you need to find the cost of financing now. The cost of financing now, which is receivables in B4 into the overdraft rate in B5. And then you need to find the cost of financing revised, where you take the revised receivables, which are 7,000, which is in B8, into its cost, which is B5. And that's it. So this is the two costs, the cost currently and the cost revised, which means the saving in the cost we can see here is B10 minus B11. The saving in the cost is $150. Well, that's good. So that means because of offering the discount, the receivables are less, and if the receivables are less, the cost of financing is less, assuming the overdraft rate remains the same. I need to compare this saving in the cost of financing to the cost of discount itself. So let's work out the cost of discount now. The cost of discount is basically the 0.2% of the 50,000, and that gives us 100. Now, is the saving more than the cost? Yes. So what you should do, well, the net saving is 50, and therefore we should offer the discount to the customers. Okay, so the net saving is 50, which is basically the B12 minus the B14, and therefore we should offer the discount. So I would just like to recap this. What have we done? We have taken, first of all, the receivables, and the revised receivables were less. If the revised receivables were less, that means the cost of financing receivables is less. And we found the saving in the cost of financing, and that saving has to be more than the cost of discount itself. And as we can see, that the net saving is 50, therefore we should offer discount to the customers. So it's not that difficult really. If you look at it, again, please make sure that you know how to find the cost of financing. If you know that, then you should be able to work out the saving in the cost of financing, now and revised, and then compare it to the cost of discount itself. And that's it. Yeah, that's how you're going to work out that offering discount part in the receivables management, which I hope now is much, much more clearer to you. Well, I hope we had more time, but in this limited time, so that you are more focused on things, that's the best we can do. And I think this was very powerful because I went through 3 great challenges in the exam. Let's just recap what we have done. We have done challenge 1, which was to look at lease versus buy. We looked at the Npv and Irr tricks. We went into the challenge 2, which was to work out multiple sources of finance and the WACC. And then we closed on the challenge 3, which is to look at the offering discounts under the receivables management. Now, I hope that we are now much more confident in what we have to do in dealing with these 3 challenges in the exam. If you have any questions on this video or anything in relation to these challenges or generally on the FM side as well, please get in touch with me on the email address which I mentioned on my first slide, and I would be very, very happy to get back to you as soon as I can. I hope that this video was very useful for you. I hope you're going to do really, really well on these areas, and I hope that you're going to ace your exams and overcome the challenges that you may face in the FM exam. Thank you very much.